Well, there is the first time home buyer. How do you get your keys? How do you get in your house? How do you get life started? FHA that most people know
Yeah.
about. But then there's the other side, which is all right, you've got your keys, you've got some equity. How do we keep you in the house? And that's what this is. Not as well known, but just as important, right?
Right.
How do you keep your keys? How do you have a good retirement? How do you have more money? So, what they did was they studied HELOCs, so lines of credits, and then they studied reverse mortgages. And what they did was basically stuck them together. They took the best of HELOCs, the best of reverse mortgage, and got rid of the bad stuff.
Okay. Interesting. Okay.
So, some of the challenges you've probably heard of with HELOCs are they're usually only good for in the ballpark of about 10 years.
Mm-hmm.
So, most banks do 10 years. So, if you take it out at 62, only pay the interest, you borrow 100 grand. At 72, you get a letter in the mail that says, thanks for being a client, paying all this interest, but you still owe 100 grand and we need it next month. And if you're 62 years old living off Social Security, now you're 72, you probably don't have 100 grand just to write a check for it, or you wouldn't have done a HELOC
Right.
in the first space,
Right.
right?
Right.
So that doesn't work out well for seniors. And then also HELOCs will have that variable interest rate with that variable payment, which affects their budget, really hurts their cash flow. And then the third problem with HELOCs is banks can actually freeze them. So most people don't know that during 2008 and then during COVID, people were getting letters in the mail that would say, "I know you think you have 100,000 available credit, you don't anymore. It's frozen." So those are some challenges that this program fixed. So there's no due date or ending date.
Oh, okay.
So you never have to worry about the note being due. There's no payment required, so you don't have to worry about that variable rate and variable payment, and then it can never be taken away or frozen once the loan's closed. So it fixes all that. And then the reverse mortgage side, of people worried about, is this the loan where I'm going to lose my house, or is this the loan where I'm going to lose all my equity? And so since they're FHA mortgages on this scenario, you own the house, you could sell the house the day after closing. It's just like any other mortgage. There's the ownership, and then there's the mortgage. The client still owns the house. They just have a mortgage on it. They can sell it whenever they want. They can actually make payments if they want to, unlike old reverse mortgages. But then the neat thing about it is that they also can pass the home on to their family. So if something happens to them, it follows their will, it follows their trust, just like any other scenario. So to boil it down is it's a regular mortgage with all the rules you've heard of mortgages, but with a flexible payment schedule.